So today's earnings gave us a pretty vivid look at what companies have to do when organic demand actually dries up. We are looking at the June 17th batch that is CarMax, Jabil, and Smith & Wesson. And the standout theme here was not some clever accounting trick. It was about physical survival and dumping historical rules just to keep the lights on.
Yeah, CarMax is the perfect place to start. They essentially had to throw away their core profit metric today. For years, they managed this rigid gross profit per unit target, but today they announced they are using dynamic algorithms to intentionally eat a $230 loss in margin per vehicle. They're completely sacrificing profit just to stop buyers from walking away. The market hated it. Stock dropped about 8%.
Right. It is literally subsidizing the customer so the pipeline does not collapse. But then you have the complete opposite happening in the same reporting window with Smith & Wesson. They quietly forced a 2 to 3% price hike across their lines back in January with zero pushback and took huge market share.
They did not lose a single sale. The stock spiked 17% because they proved extreme brand elasticity. But the real story underneath all of this is what happens when organic demand is actually weak. Look at CarMax again. Management admitted their vehicle sales only held up this quarter because people were panic buying.
Right, to front-run the impending auto tariffs. So they are not buying because the consumer is healthy. They are buying because they are afraid of future taxes. Government trade policy is actively overriding normal supply and demand.
And that is exactly what we saw in the hardware space today with Jabil. They are a heavy electronics manufacturer tied to the AI buildout, and they are actively pivoting their supply chain completely out of China.
Teaming up with the Adani Group in India to build new gigawatts of AI capacity, I think. It's just fascinating because big tech is spending billions right now. I mean, not just on better compute, but strictly to buy redundant geopolitical safety.
That is the tariff economy in action. The macro threat is forcing structural rewiring, and we see that physical constraint hitting Jabil's balance sheet too. Despite pitching this highly disciplined asset-light model, they are suddenly hoarding inventory out to 84 days.
Because they have to physically stage components for an incoming data center deployment. You can optimize your operations on a spreadsheet, but physical bottlenecks eventually catch you. Which actually brings us perfectly back to Smith & Wesson.
Right, the blue-collar talent trap. This was probably the most honest operational reality check of the day.
Totally. They officially moved their corporate headquarters down to Tennessee for better business policies and tax savings, but they just had to commit an extra $20 million entirely to their legacy factory up in Massachusetts.
Because you can move executives easily, but you cannot move specialized CNC machining talent. They basically admitted they are captive to the zip code of their most competent factory workers.
Automation hasn't replaced legacy human craft quite yet. It is just such a stark day across the board. You have AI hardware companies redesigning global trade routes and retailers artificially propped up by tariff anxiety.
And the main thing I am watching next is what happens to CarMax when that temporary tariff panic normalizes. If everyday buyers stop rushing to beat the tax, that artificial demand floor completely collapses.
Exactly. The individual company episodes in the feed have the complete transcripts showing exactly how these manufacturers are actively restructuring their physical supply chains and consumer pricing strategies on the ground. Definitely worth the deeper dive. We will see you tomorrow.